Wonderful. I've met like half of you already. This is awesome. Take a seat. You can move to, there's a couple seats in the front. I know it's like really packed back there. So just like file in as you need to. And squeeze in, squeeze in. My name is Jordan French. I run Grit Daily News outlet based here in New York. It's known for events in Times Square, just like here. Grit Daily House during South by Southwest in Austin. We have cool activation in Miami, December 1st. But enough about me. Love this space. I also run Block Telegraph News, industry trade publication, covers enterprise, Polygon supported. But this will be an awesome talk. I think a few know about it. I think you already have some questions. But without further delay, I want to introduce Sachi Kamiya is with us, Polygon's lead investor. Come on up, Sachi. I'll have you sit next to me. Big round of applause for Sachi. Going to hear from her, establish some authority. Josh Hong's here with us with Formation.fi. Josh, come on up. Grab a seat. You can sit.
Okay, cool.
You can sit. And last but not least, Yida with Shima Capital. Shima and Yida. Big round of applause for
Thank you.
For Yida. Thanks. I'm going to take a seat. I want to start with you because a lot of people are already wondering. Sorry
about that.
Yida, like why we're up here. But I actually want to start with you on this because you plowed money into like something like 50, 60 investments, and that was after you deployed 15 billion at Morgan Stanley. But my question to you is you invested in a company on the stage, Formation. A lot of people have questions about what Formation is, but why did you invest in his company?
Yeah, sure. So for us, when we think about making investments in the crypto space, one of the big themes we have is we want to invest in companies that have kind of larger traditional finance asset classes that can move on chain. And Formation.fi is a great example of that. And we look at three things when we make investments. We look at the market, the product, and the team. We really over-index to the team, which Josh is a great serial entrepreneur, been in the crypto space for many, many years. So that's another thing I liked about the project. But this massive trend of moving traditional finance assets and volumes on chain through a vehicle like Formation.fi is one that we really want to invest into. So I can let him go into the details of that.
Certainly, and we will. And your words, though, for crypto investing generally, you called it the Wild West. And a lot of people here already, who even I talked to, Yida, invest in cryptocurrencies. They can yield farm themselves. Why would they need any expertise in that?
So unless you're, being a yield farmer, it's a great job, but it takes 24/7, right? For you to really, not lose your shorts. And so I think for the most people, right, they have other jobs or they have careers that they're focusing on, and very few people have the ability to just follow everything that's in the yield farming space because so many opportunities come out, and the APYs that you can get are determined by certain factors, including timing. So something like Formation.fi can help yield farmers become yield farmers without needing to spend 24/7 in the space.
Certainly, and you mentioned yield itself, and Sachi, you have this fascinating background now that you're at Polygon as a lead investor, but formerly in equities, and understanding just broadly how markets work. And when people think of yield, they're thinking about high dividend stocks or something along those lines. How is it possible that cryptocurrencies can have a yield at all?
Yeah, so I guess one of the ways in which you can get paid yield like within crypto is like by staking your crypto into a liquidity pool. Or you may also lend out your USDC or USDT and such, so then you can get paid back like a fixed income amount, like let's say 4% and such, or you can also get paid like a variable amount. So that really depends on each protocol or what DeFi protocol you're using. Yeah.
And who sets those rates though? It sounds sounds made up.
Right. I mean, it depends. Usually it's the owner of the protocol that can set that variable interest rate or also that fixed interest rate. Like some of them, I think it's just set at like 4%. Like let's say, like Coinbase, for example, was doing this lending protocol where they would pay a fixed amount of 4% to the users. Then realistically, Coinbase is probably making a variable amount of, let's say, ranging from like 5% or 6% or so. So they take like a a 2% cut and then pay like 4% to the client itself. With the variable side, I would say that probably depends. Like it could also be based on an algorithm, or right. Mostly it's based like on some type of an algorithm that sets that variable amount.
Okay, and let's start with some absolutes, and we'll rope Josh into just a moment. But most of us just hold a crypto.
Yeah.
Should we all be looking at yield-bearing, ways to collect on top of that, other than just hold it as it is?
No, you should definitely look at diversification. That goes back to risk parity, right? Like you have to diversify your portfolio so that you protect yourself whenever the market goes down. And I think back in the days, like 2 years ago, there was a pretty big correlation between crypto, like Bitcoin and everything else. If Bitcoin went down, then all the altcoins would also go down. But now that the market has matured more, we can see where there's less correlation between all of these different types of cryptocurrencies, and you're capable of diversifying your portfolio. So yeah, I think now it's really the time to look at all these different types of protocols and try to diversify, and look at all these different types of like cryptocurrencies or also protocols to invest in.
It sounds like yield might not necessarily always be a good thing. Let's set this aside and come back to it. And Josh, Sachi mentioned this sort of what sounds like a $10 term, nerdy and perhaps institutional focus. That's risk parity. What is that?
Well, the risk parity means that you build a portfolio of different assets, and these assets have their intrinsic price volatility. And some assets are actually negatively correlated. That means when stock goes up, bond may not go along with it. So the correlation is less there. So you start looking at these assets in terms of their risks, and then look for negative correlation, and then you put them into a basket. Then in sum, these different assets behave or react to different market conditions so that your yield that you get is optimized given the unit of risk that you're taking. So it is the approach of a diversification, but you diversify your asset by looking at and analyzing your risk factors.
Certainly, and this is an artifact of history, so let's go back in time. Often there are individual investors in decades past, and from what we know, they often would chase high dividend yields or high bond yields, maybe junk bonds perhaps, and then lose their ass because the underlying went out of business or was impaired. Now, specifically though, institutions were what attempted to solve this problem. How?
Well, the more traditional institutions, let's say you are Fortune 50 and you're managing, let's say, $500 million cash treasury. And if you're a CFO, then you kind of have to think about, oh my gosh, right now money is abundant. There's so much circulation out there. So do I want to hold a lot of cash? Probably not. I want to diversify my cash into something that is safe, but at the same time, it gives me interest that is better than bank rate, or let's say better than treasury bill, or whatever the profile or the risk profile that they may have. So you start thinking in terms of managing your cash in a way that it is safe, but at the same time, you don't lose money just by holding cash. Risk parity came in because this legendary hedge fund manager, Ray Dalio, he's really into managing different currencies. And then he advised many CFOs and said, if you've got a lot of cash, this is how you manage your cash. Way to do it is this movement called risk parity. So that has been dominant sort of kind of principle that sort of helped a lot of CFOs. Now with the DeFi, with the crypto assets coming in, it created a whole new ocean of new asset class that is purely digital. And so then from a CFO's point of view, like I may get a call from my board saying, hey, you gotta get some exposure on digital currencies. And then he goes, how? What is the best approach? Because the volatility on DeFi or crypto asset is pretty huge. So I think this risk parity, which has been tried and true for the past 20 years in regular finance, we could get a lot of inspiration from that learning and then apply that in DeFi. That's sort of what is going on these days. Not necessarily being adopted in a massive way, but it is a thought that a lot of CFOs should have.
Sure, and maybe early innings, but stepping in the audience shoes, Sachi, people are wondering, they're familiar with high yielding stocks or bonds, and often those are based off cash flows from an underlying business, but where does the APY or yield from cryptos come from?
Right. So, I mean, I guess it depends on what you're looking at, but one of the common examples is like staking into a liquidity pool. Like you can stake, let's say, X amount of USDC or USDC into a liquidity pool, and then you get paid like a X amount of yield on that. It could be like a variable yield, or it might be like a fixed amount of yield. So it really depends on the protocol. You could also look at, the returns on an annual rate, like based on how the currency itself moves based on the market. So yeah, it depends on what DeFi protocol you're looking at.
Sure, and Yida?
Yeah, I can add on to that. So what's cool about having a platform to help you figure out which yields pools to go into is that a lot of times the yield is coming from the native token of the protocol. And you can think about it as a way to just incentivize certain consumer behavior, investor behavior. It's kind of like having, Amex points that you give away for, utilizing the platform. So it's a way to bootstrap liquidity. So the 100%, 200% APYs that you see or higher, that was just a way for the protocols to, bootstrap liquidity without needing to, pay very high CACs or customer acquisition costs with cash, but they just use their native token to do so. So the APYs actually go down quite a bit after this considered promotional period for a lot of the pools. So having a platform that can automatically, allocate your USDC or whatever capital that you have is another reason why we think Formation.fi is a really good platform. Again, it goes back to the fact that yield farming is a 24/7 type of job. It's honest work, but it definitely takes a lot of time, and you have to kind of know when those APYs that are, for the most part, given out by governance tokens or the native token decreases.
Josh, though, Yida mentioned as an example, Amex reward points. The yield sounds like on most of these cryptocurrencies to be made up. They behave like commodities that get traded. They don't have an underlying cash flow, at least in most cases. It sounds very centralized, in fact, and arbitrary, even in the example that Yida offered up as promotional period. You also used that term. Are those yields real?
It's a complicated question. It's just a loaded question. It is as real as what the community is willing to support. So let's say if community decides to go away and chase other protocol, then you're going to lose. Then the yield will go down significantly, if the entire market decides to go down, then it will disappear. But I think this DeFi opened up a very interesting way of looking at the intrinsic return profile, where the more I think about it, it's a bit of a Ponzi-nomics in a way, meaning like whatever the source of yield is, there is no intrinsic cash flow to back it, but if there are enough community, enough players or the DeFi yield farmers willing to support that, then it becomes real. So it's very hard to say that it is totally, let's say, it's not there. I don't believe that is the case. It's like I come from online gaming business. And when you look at in-game currencies, like you could join popular MMORPG games, are these in-game currencies real? It may not be real to regular people, but people who really play the game inside, these items are real. These in-game currency are real to them. It may not be to the non-gamers. So I look at DeFi as these intersection of a lot of these high finance coming in, but there's a lot of gameplay. There's a lot of virtual type of asset accumulation that is just purely in your mind, but it's supported by the interactions of the community. All of a sudden, it becomes real. I think the entire cryptocurrency space is based on this ideology that it may not be based on tangible asset, but because we believe in it, we give a lot of trust in it, it becomes real.
It sounds like you could also say the same for fiat currencies, though, too.
Absolutely.
In God we trust, and same for the euro. Yida?
Yeah, I was just going to say, it's the yields that you're getting are just a way to bootstrap liquidity. And there's a lot of examples of companies that need to bootstrap the liquidity, and after a while, then they can start building other types of products with a larger market cap. So it's just a really interesting token economics way to incentivize certain types of consumer behavior or trader behavior, investment
Certainly.
behavior.
And Sachi, you offered up an example of yields like 4%. That already sounds astronomically high relative to what we could get on certificate of deposits if anyone uses those anymore, or money markets, for example. And those go up to much higher numbers, though, than 4% that you've seen. Can you just share some maybe a hyperbolic example that you've seen?
Well, I think it's interesting to see a contrast between the APYs that you can see in crypto and within traditional finance. Like if you buy a US Treasury, you can maybe make 25 bips or 1/4% on that, it blows my mind, right? So then I remember the first time when I got into crypto, I saw this liquidity pool that was paying out like 400%. And I was like, how does this even exist? Like, how is this real? Like within traditional finance, if you see 10% on a bond, that's like phenomenal. So
it implies a lot of risk, though, at
right.
10% a bond. So at 400% implies extreme risk. No?
Right. Yeah. No. So
for the liquidity pool that you referred to.
Definitely. Yeah. So I mean, it's interesting to see the contrast between like finance in crypto and finance within the traditional markets, because like I don't know if you guys have followed what happened like last year. There was a whole like credit market crisis. Like credit spreads were going up like 100 bips a day, and there was like the market was just not functioning well. So then the Fed stepped in basically and helped save the entire market, but that doesn't really happen in crypto, and that's, I'm assuming, part of the reason why we see these like crazy APYs like 25% and such.
Well, perhaps it does, and the Fed is in those markets at an arm's length away. But we'll set that aside and get to that in a couple of minutes. But an example, for perhaps that I've seen, you offered up 4%. I've seen 16%, even 22% at sometimes. You also offered up 400%, to be fair, in a liquidity pool. It just implies a lot of extreme risk. It makes you wonder what risks they are taking. What's implied, perhaps, though, also, Josh, is that all cryptocurrencies could approach, zero at some point.
I suppose so. Yeah, it's highly unlikely, but theoretically, it's within the realm of possibility.
Okay, and then within the paradigm, though, if you put that in the paradigm of risk parity, doesn't it make sense to just simply chase the highest possible yield that you can get? Because if the risk is ever present that one or any number of cryptocurrencies goes to zero, you might as well buffer that, right, with the yield. Why would that not make sense?
Well, I mean, like if you take the approach of more of a speculator, absolutely yes, because you're betting each time you're taking this enormous risk, but also you are rewarded for that bet that you make. Now, if you're a long-term investor where if you're CFO of a company and you got to protect your cash because you got bills to pay, you got payrolls to meet, then you really have to think in terms of long-term protection of your investment. So then it gets a little bit complicated, right? So because you want that yield, because DeFi gives you that incredible yield, even knowing that there's a little bit of a fluff in there, but you want it because maybe that's what the board is demanding. But at the same time, you got to think maybe 12, 14, 16 months down the road. So then how do you create a portfolio that gives you protection? So I think that's really the choice between, do I want to be a speculator or do I want to be an investor with the protection in mind?
Certainly, and we'll get to you in a second, Yida, and actually I'll direct this towards you if you want to answer it. There's one way, interestingly though, to remove that speculation, right? At least relative to the US dollar, and that's with stable coins. And in fact, it turns out or yield on some stable coins, Josh, Yida, and Sachi. And so within the risk parity paradigm and that Joshua and Formation.fi are operating within, wouldn't it then make sense to simply chase yield, Yida, within the stable coins, not worry about the cryptocurrencies, and capitalize on whatever highest yield you can get on a USDT, a USDC, or something that's backed by, or DAO that might be backed by the US dollar?
Yeah, no, I think it just depends on your risk tolerance, right? And so a lot of yield is definitely getting generated from an aggregate volume from stablecoin yields, but the utilization of stablecoin for these pools can be low at times. It really depends on the market, because if you think about like the real cost that's getting paid, it's on the borrowers, right? If you're talking about using that in a lending perspective, so there's ways that you can lend out your stablecoin and then get paid, kind of like 5 to 10% depending on what the utilization is of that pool. But it's not all fluff, right? Because you still can get a percentage, because everything is decentralized. What is the whole point of having these tokens in a pool? It's to add liquidity so that people can trade in and out of that native token. And usually usually a pair of tokens, stablecoin plus the native governance token. So a percentage of each trade actually goes to the providers of the liquidity. So there's actual costs and revenues that are out there in these pools. And I'd also like to say that there are a lot of large DAOs now that have this treasury management issue where they're managing hundreds, if not billions of dollars in smart contracts. And so it probably doesn't make sense for Johnson & Johnson to use Formation.fi today, but it makes a lot of sense for the equivalent size company relative to the crypto space to use it today because of their inherent need to diversify their treasury. So there's a lot of low-hanging fruit, I think, for Formation.fi to tackle.
And this paradigm is also still laden with assumptions, though, and that gives us a curious question. Sachi, why are the yields so much higher on a USDT, USDC, or a DAO versus the US dollar? Wouldn't it make sense to just borrow money from perhaps traditional banks and then invest it in the Tether or
USDC,
equivalent,
right,
and then just capture the yield difference?
Yeah, so I think I actually read a really interesting article like a couple of months ago. It was actually written by Bank of America, and it mentioned how like USDT is actually one of the largest holders of commercial paper. And that just really blew my mind, because back in the day, it's all institutions, like pension funds, the Federal Reserve, that were holding like these commercial papers or money market bonds. But now it's like crypto is really becoming mainstream to a point where they're really dominating even within the traditional finance markets. But another point that I wanted to mention is that like these stable coins aren't risk-free. Like there's definitely some risk in it, and I think we're still very early stage within the crypto space to like, we still haven't experienced, like there's probably gonna be other market crises, and it'd be interesting to see how USDT and USDC like behaves in that, because that's when the market is stressed, that's when you see like flaws in multiple like securities or instruments and such. So right, like the reason why USDC or USDT might like yield more, probably because there's some inherent risk in it too.
Perhaps, but it's fair game since you mentioned the Fed earlier. In your example of March 2020, during sort of the outbreak or
right, COVID outfit.
Yeah, of COVID.
Right.
Particularly in the U.S., where the Fed is going to care about predominantly its own monetary system, even though it's quite global.
Yeah.
The Fed stepped in.
Right.
So isn't it in fact the case that the Fed is backstopping all of this, including the stable coins, because those are dollar denominated?
Right. Yeah, I mean, I think it's all interconnected one way or another, right? Like we also were talking earlier about how like Bitcoin is connected to USDC and USDT. Like it'd be really interesting to see like if the price of USDC or USDT were to drop, like what would happen to the price of Bitcoin, or what would happen to the price of Ether. So yeah, that's definitely a really interesting topic to
And when you
explore.
say a price drop, do you mean relative to US dollar or with and in tandem to the US dollar?
Relative to
price
the
drop.
US dollar, yeah.
Okay. And what does that imply if there was a price drop relative to the US dollar?
Oh, then that means there probably isn't enough collateral to back like the currency itself.
And the collateral will be the commercial paper that you referred to that the US Treasury issued.
Right, or just straight cash like USD.
Fascinating.
Yeah.
Yida.
So yeah, another reason why the yields are like 5 to 10% on USDC in stablecoin is that you got to think about who's borrowing that USDC, right? If it's mainly traders, right? And they're making 20, 30, 40, 50% off of that borrowed stablecoin. And this is like one of the beauties of crypto is that you can go in and out of stablecoins much faster than wiring $1 million to yourself, you know, or borrowing that money from like a bank or you know, kind of normal on-ramps, fiat on-ramps. So it's just a lot faster. And so when you're a high frequency trading firm or you know, you're just a firm that is using Binance or even decentralized exchanges like 1inch to trade, you want to move in and out very quickly and 24/7. And if you go through, you know, a traditional bank like Chase, you know, you can only do that 9 to 5 Monday through, you know, Friday. So that's another reason why the rates are higher, is that on the demand side, you know, there are people and entities and traders that are buying and you know, borrowing that stablecoin and achieving higher yields themselves.
Who's the counterparty though to the risk that particular trader is taking?
The counterparty would just be other traders, right, in the market. So I'm just saying there are borrowers, traders that are okay borrowing USDC at 10% because if that's the rate, because they're making 20% or more, 30%.
Right, but on the topic of the risk though, that's being borne by the lender. Is that what you're saying, or the institution that's coordinating the transaction in these cases? In your example.
Yeah, in my example, it would just be, you know, it depends if it's, you know, fully on chain, then the smart contract, right, that you're using to basically borrow, like let's say a platform like Aave that allows you to, you know, lend out your stablecoin or your Ethereum through completely decentralized manner where you don't need to have a middleman like a bank. So I guess that's some of the risks. You have to put down collateral in order to, you know, borrow stablecoin. But not every single stablecoin is created equal either, right? You have ones like Tether. Some people, you know, back in 2017 thought they may not have the capital, maybe even now, so they could be trading under $1. But there are other ones that a little bit, it's not 100% riskless, right? It's not the Fed, but has pretty high chance of having the one-on-one backing.
Spooky, but maybe too soon to say that. We're gonna open up the questions in just a minute. I'll give you the last word, Josh.
Yeah, so I think if you look at DeFi and what drove DeFi's growth has been this mindset where I can make a ton of money fast. It's very much a opportunistic, speculative kind of mindset, and I think it worked for a while, and until it doesn't. And I think the crypto winter is just around the corner, and we all know it. And I think we need to be prepared for that. And it just requires different mindset. And the mindset is not so much about how can I make more by doing the yield farming, but how can I protect myself from these environmental changes that is beyond my control. Because I can't control Federal Reserve, I can't control US government, I cannot control these protocol risks. So the best approach to creating protection is actually diversification. And in DeFi, diversification has a little bit of a different way of doing things. It's not like regular finance because you're dealing with a lot of algorithmic stuff. There's not a lot of human beings behind it. So Formation.fi come in, and then we're basically proposing a new idea where, hey, this risk parity thing worked pretty well. Let's bring that idea into DeFi, but we will modify it in such a way that it can be optimizing. And then it will help you construct your diversified portfolio in a way that it's based on mindset of thinking through your risks, not so much on the, going for the moon. Because I think, moon is great, but there's always hell down there. So you need to kind of sort of strike the right balance. And so we're hoping that, our approach will work, and, would love to engage more conversation with you guys.
So biblical. I do want to open the questions. I know there were some before we even started. We have a walking mic. We'll walk to it. We'll start over here. And just say your name and then your question.
Yeah, hi, I'm Scott Morgan. Thank you very much for your contribution to the panel. It's really good. I'm just looking, for example, I've become really interested in UST. I like the idea that you start off with a stable or decentralized stable coin, therefore you don't have anybody who can back up later and say, we can't or cannot do like USDC or USDT as we've shown in the state of New York, for example. What is also a appealing factor for them is that it seems like they're having the velocity increase on USDT by having so many more players basically built into the system, and therefore Luna is just really stable or as an asset which basically can then reflect back on UST and actually take, either way can take the risk. And by de-risking that, it comes down to a really simple question. It's like, I don't understand the idea of risk parity on a DeFi central side. I understand the idea of risk parity on if you took like a systemic and had to try to take out systemic risk, and part of that systemic risk factor is not only smart contract, but also the idea of like, what's being built on top in terms of layer risk and regulation. So I guess my question is, how do you get around that risk, for example, of being hit by something which is now, if you are yield farming based on moving from one farm to the next, how would you, I'm not sure where you're located, but how would you, basically de-risk yourself from being, slapped with a subpoena to tell you to stop?
I can restate the question. I think it's directed towards you, Josh. Probably the best one to answer it, but the question just repeated back is, how do you account for what sounds like regulatory or legal risk in the space?
It's so we're dealing with a systemic risk, and a lot of it is very difficult to manage. I mean, you're dealing with governments, you're dealing with politicians, and you're dealing with geopolitical stuff that is just so complicated. So I think we tend to limit our scope within DeFi space, and so between layer one solutions, not all layer ones are created equal. So we tend to go for ones that has a much larger TVL, and then try to stay away from the new emerging ones simply because they just need time to develop their community and have a much more secure code. So for example, I mean, like we're very much focused on, let's say, Ethereum Mainnet, and also BSC, some Polygon, and maybe Hecko. There are other very exciting L1-based DeFi solutions out there, but we are a lot more careful. Our basic sort of kind of focus is, we prefer L1 solutions that has higher than at least like 10 billion TVL in it. Anything below, we would sort of kind of stay away for a while and allow them to make some of their adjustments.
And Yida to add, and then we'll go to the question here.
Oh yeah, another way about the regulatory front, if this becomes fully decentralized, there's nobody to send a subpoena to. So the whole goal, right, of crypto and this whole parallel universe is that if you become decentralized enough, then it's hard for regulators to go after you. I mean, why was Bitcoin even founded or launched in 2008, right? So one of the reasons was to have better kind of custody of your own assets and not have any issues with regulations or big banks. And so one of the beauties of crypto, and the IRS and others, SEC may not like to hear this, but if you can have your tokens or your assets on chain already, and the platform is fully decentralized, where all of the yields are based on proposals that the DAO makes, then it's hard to kind of be in the purview of the SEC. or any other regulatory.
Evasion being a second answer there. And then you had a question over here?
Hi guys, my name is Bill. First of all, Gary Gensler's hiding behind the curtain there. And Yida, thank you for your explanation on the stablecoins. That really resonated with me, that they're just a more efficient transit layer than fiat and getting in and out for what we're doing. A little bit of a far out question, but Josh sort of brought it up. But does either foundation or Shima have any plans for investing in MMOG NFTs in the future?
It's a good question. I'll repeat it for you so our audience can hear it. You plan to invest in NFTs, but particularly a species that's gaming like MMORPG. Did you say?
MMOG.
MMOG. Okay, totally different.
And I think your question was directed to Shima, right?
Yeah, I mean,
Yeah.
Either really.
Fire away, Yida.
I would say yes. We invest across different all the verticals within crypto, from infrastructure plays in one end of the spectrum and middleware to DeFi, gaming, metaverses, social coins, NFTs on the other end of the spectrum, and then everything in between, including DAOs and whatnot. I think Sachi, you guys, Polygon
Yeah.
also does a lot of gaming specifically too, right?
No, so we were actually looking at a game, and we signed like a SAFT, well, not tokens, but actually NFTs. So we're going to receive like X amount of NFTs from this specific game, and it's locked for like 2 years. So it's similar to a token, but instead like an NFT. So yeah, I mean, I feel like I've been seeing a lot of funds. Like there's this other fund called Republic Realm, which focuses on investing in like real estate within the metaverses, and also looks at investing in NFTs and such. So I think, yeah, it's been really exciting looking at this cycle with like NFT and gaming just exploding. We see how a lot of these investors also find value in these NFTs.
So repeat this back to you though. NFTs can also yield, like a cryptocurrency can.
Yeah. I mean,
That's what you just
there's also like DeFi protocols, like NFT/DeFi protocols, where you can also post your NFT and get yield on that by like lending it out to other people. So it's an entire different world, but it makes sense. If an NFT has value, then we should be able to treat it like a security also.
Yeah, have to be our next panel on that. I think there's one more question that you pointed out, Sabrina. Oh, you're right here in the middle.
I wanted to zoom out. Josh, I think I heard you say that you sound very sure that the bull market will come to an end eventually, and I'm with you. But I'm wondering if any of you guys maybe disagree in that, like the fundamentals changing so much with us apparently hitting critical mass. Is there a chance that maybe we never really hit another super bear market? Maybe we just crab along for years to come? Like, are you guys so confident that the bear is just around the corner?
Yes. So the question: is it possible that because of mainstream adoption, we don't hit another, perma bear or persistent bear market? Josh?
Yeah, I mean, like this super bear market that we just went through that lasted more than 2 years. Will this happen again? In my guts, absolutely, it's gonna happen again. It's just a matter of when, because it's a human psychology. I mean, like this entire economic cycle is almost like a 4-season sort of thing. Many economists in the past always kind of sort of use this analogy where there's a seasonal thing to this economic cycle. It's not because of it's purely money, but it's because it's a human behavioral thing, right? You can't be like working constantly 24/7. There has to be some, downtime. I think the economic cycle works in similar ways. So like I'm not giving you any like sort of quantitative based reasoning here, but it's more philosophical. I think it's because it's about human minds. How do we engage with this physical world? And there are certain laws that kind of governs our behavior. So I do believe that there will be major sort of winter cycle coming in. It's just a matter of time. I don't know whether it's going to happen right away. There will be many bumpy roads back and forth. I'm a crypto bull. Like I'm very bullish. I'm all in, just like many of you. So I am rooting for everyone and also for myself that we will perform. But at some point, it'll be out.
It sounds like that's answered in the affirmative. It sounds like either a Bear or Gary Gensler maybe liked or didn't like your answer. We'll have to find out later. There's one more question back. If you could make it a yes or no question, we'd have time for it. Fire away. Your name?
Might be a little longer than that, but I'm Jerry. Hi, thank you guys. Just quick, how do you also approach the risk framework of getting yield on Bitcoin, especially if it's going to be like wrapped Bitcoin or red Bitcoin that you're using on Ethereum or other elements?
Can we answer it in a sentence, and then we'll take this question offline?
Yeah, I think it's going to totally happen. The wrap BTC, there are many varieties. They're all, most of them are non-Bitcoin stuff. So yeah, I think it's going to provide some very interesting yield profile.
Yeah, we can add to that after the panel. That's all the time that we have. My name is Jordan French, Crypto Daily News, Block Telegraph. Big round of applause for Sachi Kamiya. Thanks for joining us up here. Here, we're shaking hands like that right there. Yeah. Josh Hahn and Yida. Gao, thanks, and until next time, everyone. These gentlemen and lady will be available for questions right after this. Thanks for coming.